Hey, good morning, everybody. It's Hammer. Today is Friday, April 4th, 2025. Let's see. They made some changes on the STEM program, so everything's all out of sorts. Anyway, good morning, y'all. Great to see you. My name is Hammer. Of course, I'm here with your daily mortgage rate update, the only place on the web where you can join me live each and every weekday morning, 9:30 a.m. Eastern time, broadcasting on Facebook and on YouTube. If you're here live, say good morning. If you're watching on the replay, do me a favor, give me a hashtag replay in the comments. Let me know that you were here. Don't forget to smash that like button, tag an fellow friend, share this post in a group. If you would like to be reminded that I'm going live, you can get a text alert. You can sign up for those at hmmr.io/reminder or use this cool QR code on your screen. You can also, if you're on your phone now, take a screenshot, go back to your photos, and that QR code will work. I always get tickled by that. I always think it's the coolest thing ever. Let's say hi to the live folks this morning. Julie Lawrence, Amy Blauser, great to have you all here. Dan Herbert. Amy, I was so excited to have that calendar for you for Grab and Go Social and how it looks on mobile. Everything. You're going to love where this thing is in just a couple more weeks. We're moving as quick as we can on all this stuff. We've got a lot of content that we're pumping in there, man. Oh, I am so excited though. I love, you don't understand what we went through trying to find testing different calendar apps until we finally found one that was dialed in. So excited about that. We will be blowing that thing up with content soon. So anyway, good morning, Bill Schwegler. Great to see you. Yasmin Martin, Randy Leonard. Good morning. Cindy Prince, Dave Holland, you're back. Dave Holland is back, everybody. Jerry Vila, good morning, sir. Tom Denmore, great to have you here. I'm sure there's a bunch of people I probably missed already this morning. Candy Williams, Mike Morano, great to have you guys here as well. All right, let's get into the meat and the potatoes of it all. We're going to go ahead and let's go ahead and let's get started. And I will show this to you. So today was jobs data. However, based on what you see on the screen this morning, you would never know it. Now, let me explain to you what a big deal this actually is. All right. So on any other jobs data, on any other Friday where we have jobs data, you would see that being the number one headline here on Wall Street Journal. There'd be a live thing about it. Look at this. You don't even know what the jobs numbers are. You don't even know what the jobs numbers are until you get below the fold. Hiring defied expectations in March with 228,000 new jobs. There were only 140,000 jobs expected to be created. That is a huge, huge number. Normally, what would happen when we see that big of a miss, it's not really a miss. It's when you have that many more jobs created than what was forecast and what was expected, that would normally mean that you're going to see much worse rate sheets on the day. However, as you can tell here on the Wall Street Journal, that is taking a huge backseat, as I said it would, to what's going on with the tariff stuff. And right now, again, even on Bloomberg, it's all about the tariffs. Trump tariffs clouds market reaction to U.S. jobs data. That is a great headline. Let's go ahead and talk about what it's talking about here. Bond yields sink on recession fears. So just to reiterate, I don't care if you agree with the tariffs. I don't care if you like or don't like Trump. None of that matters. What we're focusing on here is what is our here and now world? What effect is that having on mortgage rates? And how do you best take care of your clients and get some business? Okay. We've always talked about how there's going to be windows where there's opportunities to go ahead and get business. And this is one of them. Now, the real question is how good can this get and what direction is it going? Let's take a look at a few different things. So first of all, just to kind of put a pin in that jobs data, right? Payroll growth came in much higher than expected. 228,000 jobs that were created, non-farm payrolls, versus expectations of 140,000. However, it would have been a mixed report anyway because unemployment rate ticked up to 4.2%. It was at 4.1%. Remember, those are two different things. One is a business survey where they're surveying for the number of jobs created. The unemployment number is a household survey where they're calling people. Now, they don't just say, do you have a job or don't you have a job? They say, do you have a job? If you don't have a job, are you looking for a job? Now, the looking for a job is what we call the participation rate. The participation rate did increase. So there are more people that are participating in the job market because you're not considered unemployed unless you don't have a job and you're looking for a job. If you don't have a job, but you're retired, you're not unemployed. That's how it works, right? So 4.2% is higher than 4.1%. So we've seen that number climb, but none of this really was enough to make much of a change at all. When we take a look at what was happening with mortgage-backed securities, I've got the 10-year treasury yield on the screen. Let me go back to the to mortgage-backed securities. Come on, click on that. There we go. Okay. So taking a look here, you can see, huge numbers. So let's recap what happened yesterday. We know, if we put this on 5 days, you could see huge jump yesterday, and then it kind of leveled off, right? So yesterday, bonds started the day with gains, held the gains through the day. This morning, another huge jump in bonds. 10-year treasury yield back down below 4. I told you was a very real possibility. Said it wasn't guaranteed, but it was a very real possibility. We were flirting with it yesterday. It ended the day yesterday at 4.03. Today we were at 3.93. It has broken below that 4.0 mark. Now, as far as technicals go, that's not a big deal. Again, the bigger concern is what's going on with markets, stock markets, having just total meltdowns. So we really don't want to worry too much about what technical levels, the fact that it broke below 4%, what effect that's having on traders, because they're not thinking about that right now. What they're trying to do is to avoid losing their shirts. Okay. Stocks have gone through the floor, and they say this is a once in a century kind of event. If we take the pandemic, which was its own black swan event, out of the scenario, we haven't seen moves like this since the 70s. That's what they're really looking at. But as far as where mortgage-backed securities were, they jumped really well, 100.66. But the higher levels, like before the jobs data came out, they were around 100.79. So it's about 13 basis points lower than where it was then. That's certainly not a big deal, and it's really not directly a big deal because of the jobs data. It's just kind of where the trading is. Now, where would we go from here? It's important that we look back. What were our best levels? What was the 10-year treasury at? And what were mortgage-backed securities at back in September when we saw the best rates, and rates were in the low sixes? The 10-year was at 3.61, and mortgage-backed securities were at 100, at least this coupon, the 5.5 coupon, was at 100.61. All right. So we would have about 90 basis points that we'd have to improve in order to see rate sheets theoretically matching what we saw in September, because the rates should match where bonds were, right? That's what would make sense. Now, Ron said the jobs number would have had a much bigger effect today if it wasn't preempted a couple hours before with the retaliator tariffs from China. Yeah, so that's the biggest thing that's going to get the headlines. That's what Ron's talking about. Market turmoil deepens as China sets 34% tariffs. And that's why we saw even more of a meltdown and why we've seen bonds improving. So again, I'll go into the whys a little bit more in a minute, but let's talk about where we go from here and kind of what we've seen. So a few things to recognize when it comes to pricing. We've passed that point where lenders you're going to see different rate sheets pass along different amounts of these gains. So let's talk about where rates were and where they've come from. So 327 was last Thursday. 328 was last Friday. Last Thursday, last Wednesday, last Tuesday, rates were at around 6 7/8. All right. As the rates fall, what happens with lenders? Lenders have to renegotiate rates, triggers float downs. Has anybody had any float downs yet? Let me know in the comments if you've had any float downs. I'm not a big fan of telling people that are in a broker scenario that they should break locks, but if your lenders are not willing to float down, then most likely you're going to be breaking locks because you're going to have to do that to keep the loan, or else you're going to lose the loan. We're going to continue to see rates go down. But right now, you've got lenders and rate sheets. They're going to fatten their margins a little bit. That's generally what happens. They're going to basically they're helping to defend against more volatility, and where things would go next. They're also defending against those renegotiations and the rate lock. So Julie Lawrence said no, but thinking of one with a jumbo today. Yeah, jumbo's going to be a little bit harder, of course, but yeah, I mean, and you know what? If you don't see it today, we very well may see rates continue to go down heading into next week. Now, I say may, and I seem to be hedging. I'm not wishy-washy. Here's the deal. As we see more escalation to all of this stuff, right? As we see stocks continue to just see face melter days, with stocks just totally taking it on the chin, right? That's the same article. Hold on, let's go to this one. No relief for stocks as risks mount to the economy. You're going to hear more of the R word, recession. Right now, we've got expectations of Fed rate cuts. They're pricing in 1.25. I'm not even going to say 5 cuts, because it wouldn't be, I don't think that they're expecting to see quarter point cuts right now. What markets are currently forecasting is that the economy is going to just slam on the brakes in the next couple months. And they, remember, we're at 4.25 for a Fed funds rate, 4.25 to 4.5. 3.75 to 4, that's a half a point lower than where we're at now. That would be 2 quarter point rate cuts, which is what the Fed officials had on the dot plot, right? And I'll come back to you, Randy. It should be a quarter, not 3/4. You talk about 3/4 of a point drop in pricing or in rate. Most lenders, it should be a quarter point in rate. If maybe I'm out of touch, y'all. But that's why I talk about locking, so anyway, take a look here though. If the Fed officials, they were figuring 2 quarter point rate cuts, that would bring us to 3.75. Markets, 1% probability of that. No probability that will be at 4.25 or even 4. All right. Now let's use the compare feature. Look at this. This was a week ago that we would see no rate cuts. A week ago that we would see 1 rate cut. A week ago that we would see 2 rate cuts. That's barely even a possibility right now. Look at what has the number one. The number one is between either 3 or 3.25. That's 1 point to 1.25 point lower in Fed funds rate. That was not even a possibility a week ago. 7.65 all the way up to 35. That's 5 times as high. There was no expectation we would be lower than that. Look at that here. Markets are in full panic mode. Now, Fed Chair Jerome Powell, by the way, going to be speaking later this afternoon. Markets are going to be looking for any signals that the Fed is going to help and throw a lifeline, that the Fed would do rate cuts. And I don't think Powell wants to commit to anything. Powell's not trying to calm the stock market down. It's not his job. So there is still so much uncertainty going on here as we see all these kinds of things. But remember something, and again, I don't care whether you love him or hate him. I'm going to talk about Trump. Everyone keep your big person pants on, okay? Trump will flip-flop on these things like that. He's already, there's news, there's video shots of him talking about that maybe China will go ahead and bless the sale of TikTok, and that could be part of getting their tariffs released, or that there could be other offers. So you're going to hear all of this, right? But as long as we see more of this fear and volatility and uncertainty heading into next week, we're going to see rates improve. Now, the 10-year would need to go down about another 30 ticks, not ticks, but another 30, basis points to bring us to those September numbers. Right now, rates, when you look at rate sheets, We should be at least 6.5 right now. You should see rates go down at least another eighth today. We should be a quarter to 3/8 of a point better than where we were at a week ago. Is that where you're going to see rate sheets? Again, I don't know. Like Randy said, okay, so you said price, Randy, 3/4 of a point in price. That should be easy. Yeah, moving the file isn't fun, but it's a real concern. And absolutely. And here's the thing. You don't want to do it too early though, because we don't know where this is going to end. So I'm going to throw let me just pull up on the other screen. I'm going to throw my lock advice up real quick. And bear with me a second. I'm just pulling this out here. All right. So let me put this up here for you. And I'll just kind of highlight this section. So loans closing in 15 days, cautiously float, need to be on guard for when we see a momentum change. And because what's going to happen is, remember, we have seen this just so much fuel on this fire. And when we do see something turn, it's likely to move quick, and it won't be forever. But when we do see some kind of hope or reversal or slowdown to this, we're likely to see it happen fast, and it's going to be hard on rate sheets. It's going to hit hard. That's my expectation. So loans closing near term, you've got to keep an eye on it. I'm very weary of when we see that reversal, but I don't think we see that reversal heading into next week. Loans 15 to 30 days, there's just way too much out there. That means we can get better. I'd be floating in 30 plus, especially. Again, the technicals, not much of a concern right now. We want to be looking at that 10-year treasury yield. We need that. If we see that drop down 3.6s, that's going to be the area. For mortgage-backed securities, they need to jump up another 100 basis points. You're talking about going up to 101.60 to be in September. Now we've only gone up. Last Thursday was 99.45. Right now we're at 100.61. So that's 115 basis points that we've gone up through all of this. We would have to double the gains that we've already seen in order to see rates go down to where they were in September. Just trying to give you guys that spectrum of what would bring rate sheets there. Yes, and Randy, that's exactly what I'm trying to get across, and what I've was saying before is there's a real variety of rate sheets with lenders, different pricing strategies changing often. And I said that 5 minutes ago, where you're definitely going to see that. You're going to see lenders that are. I had it right here in my written info too. I said we've passed the point now where many lenders will fatten margins and not improve rate sheets as much, partly to protect from volatility, partly to protect recent locks that they don't want to renegotiate. All right. Reprice risk on the day is moderate because lenders lenders that are being aggressive may be quick to pull some of that back. It is a Friday. They've got the weekend. They're going to worry about what could happen. Remember, politics doesn't take off for the weekend. We could see some big announcement about these tariffs over the weekend and wake up with a very different thing going on for Monday. So we have to be aware of that. But overall, I mean, I'll stay with where I'm at here. And let me see if I've got it down on my captions here. So I'll pop it out there. Cautiously float anything closing near term. And I would still be floating the rest. Even if we start to see a pullback, this is an event that's going to happen over days, not minutes. We're going to see some pullback, but it's absolutely insane how what normally we would be talking all about jobs data this morning and expectations on what this could do. And this is all just taking a huge backseat. And it also puts it's kind of a difficult thing too for traders, because if the labor market is strong, now the unemployment ticking to 4.2 helps a little, but if the labor market is strong, you're talking about non-farm payrolls coming in much higher than expected. That doesn't open the door for the Fed to cut rates. And so you have data that's just not going to meet, right? Because the markets are looking for the Fed to be cutting rates big time. That's why I showed you this, where markets are looking for a point to a point and a quarter in rate cuts by the end of the year right now. That's what they're forecasting. And then you get this kind of jobs data, but that's why they're just really kind of dismissing it altogether. So anyway, my friends, this is what you've been looking for getting business. Would love to hear any challenges that y'all are having, talking to consumers or what they're saying or, that kind of a thing. Let me know in the comments. Always curious about that. Otherwise, have a fantastic weekend. Good morning, Jessica Wells. Made it to the end. It's 20 minutes, so I'm going to wrap up. And let me know in the comments if you guys are have any questions. So yes, you need to be out there though, beating the drum, taking applications. Tell everybody that it may not be time to lock yet, but you want to get the application, get their documents. You right now, this is going to create a little refi boom. You're not seeing it fully on the rate sheets yet. It's kind of disappointing to see the way that, these huge headlines about what's going on, and yet rate sheets have only improved, on average a quarter point, but they're going to continue to tick lower. You should be at about 3/8 of a point in rate better than where we were. So Krista, I'm floating and working. Cherry, I made it live too, a bit late. Good morning, Cherry. Derek Weibel, some will see the news of potential cuts and wait. Yeah. So you and it's your job to explain to them why those Fed rate cuts aren't going to help mortgage rates go down. Mortgage rates are reacting to what's happening now. So sent an email, subject market rate refi. Yeah. We actually, for Originator Success members, we sent out a keep in touch campaign piece yesterday that will actually help with rates and stuff too. So, all right, my friends. Yeah, exactly. Told them I was watching, but wanted to have their mortgage statement. That's the way to do it. So, all right, y'all. Well, have a fantastic weekend. I am going camping with some friends. I'll call it glamping. We're renting one of the cabins that they have out at a KOA up in Pigeon Forge, and our friends have the RVs, yeah, RVs. So they're taking those, and we'll rent one of those because I don't have an RV. I don't want one. So anyway, hope you all have a fantastic weekend. I will see you on. Oh, Jessica, I got several responses yesterday from the Keep in Touch. Awesome, Jessica. I would love to hear more about that, by the way. Hit me up on Messenger. Let me know if any of them turn into leads or loans. I love to hear that. So we'll probably be doing a little bit more with that as well next week. I may send out a specialty piece. So we'll talk more. All right, my friends, have a great one. And I hope you guys are getting out there and getting busy.